Earnings season is like Christmas for investors, except we get it 4 times a year. Either we get a huge gain, but sometimes we get a big loss. But I view either one of those as a positive. With a gain, we just made even more appreciation. And with a loss, well, we get an opportunity to stack even more shares. That said, a healthcare giant released their earnings today, but I have a mixed review. Welcome to the Quality Investor. Always one of the first businesses up during earnings season, UnitedHealth Group, ticker UNH, released their earnings. And apparently, the market was pretty happy with the result. But here on The Quality Investor, we're not going to take a victory lap quite yet. We're going to dive into these earnings and see where UnitedHealth did well, but also see where UnitedHealth didn't do so well. But as always with earnings season, what we want to assess is if the fundamentals of our investment thesis remain intact. Before we dive in, remember to hit that like button and subscribe to the channel to stay up to date on all the quality businesses in the market. UnitedHealth finished the day with just over a 5% gain. But what I'm looking for in these earnings are a couple different things. The first is medical cost ratio, or how much in claims did UnitedHealth pay out relative to the premiums they collected. The next thing I'm looking for is enrollments, or how many people did UnitedHealth gain as insured persons. We also want to see, what did UnitedHealth guide for the future? Have the expectations changed at all? All of this taken together should give us a good idea if the gain that we saw today is justified or not. Looking at UnitedHealth's results today, we can see they closed the day at $468.89, which is a 5.2% gain. Finally, some positive news after pretty rough year so far. You can see year to date, they're already down 13%. I've already done a couple videos on UnitedHealth's troubles for 2024. They're linked in the description below. But essentially, they've had a lot of external pressure. They're facing an investigation from the Department of Justice. Medicare payments came in lower than expected. And they've also been dragged down by their peers, such as Humana. But the thing to understand is none of those events actually affected the fundamentals of UnitedHealth's business. The closest thing that came to it was the Medicare issue, but I explained that in that video. The point is, I believe UnitedHealth is down this year, not for fundamental reasons, but because of the news, because of a fear that has been hanging over UnitedHealth and healthcare in general. And because of that, I believe that UnitedHealth is currently traded well below their intrinsic value. You can see they had a beat on earnings per share of 4.3% and slightly beat revenue by just about 0.5%. Earnings per share came in at $6.91 and revenue came in at $99.8 billion. Both healthy increases year over year. While initially that looks pretty positive for UnitedHealth, I was actually surprised the stock jumped the way it did today, because once we dig into these numbers, you'll see it's not as rosy as it looks. They actually highlighted some of their less than desirable results right away in their earnings release. They noted their earnings per share impact from the Change Healthcare cyber attack that occurred earlier this year, essentially having to pay costs that were associated with that and lost revenue as well. They also provided over $6 billion in advanced funding to support care providers in need. We'll see how that impacted their free cash flow later. And they also closed on a sale of their Brazilian health insurance unit. That was reported late in 2023, and essentially is a very underperforming unit. So this will be value accretive going forward, but they did incur a hit this year. We'll get into the numbers here in a minute. But what I want to point out now is the medical cost ratio. Their medical cost ratio for Q1 was 84.3%. And that's actually an increase year over year from 82.2%. That's a 201 basis point increase. My expectation for that medical cost ratio was at about 83.5% for this quarter. When I initially read this earnings release, my first thought was, wow, they're going to take a hit. And that's one reason why I was so surprised, because that medical cost ratio was a lot higher than what myself and analysts, of course, were expecting. And markets usually sell on margin contraction. One bright spot, however, is they increased the total domestic consumers by 2 million in first quarter. While there was a small increase in the Medicaid enrollees, overall the growth helped push a 6.5% increase year over year for the United Healthcare insurance business. All in all, we're still seeing that strong domestic growth for the health insurance. However, the smaller health provider arm of UnitedHealth's business continued its very strong growth. Revenues for Optum were $61.1 billion at the end of the quarter, very strong 13% growth year over year. Optum continues to prove itself as a great growth driver for UnitedHealth overall. So after seeing these results, my first thought was maybe the market's correcting itself a little bit after overreacting to some of the news out there. As we just saw, the fundamentals, their core growth drivers, continued to grow. They had a bit higher medical cost ratio, but the market seemed to brush it off. Overall, revenues grew at about 8.5% year over year. But we come down here to earnings per share, and we see it gets a little hairy. Their actual GAAP earnings per share was a negative $1.53, a huge decline from the $5.95 year over year. But you can see right below, they actually had an adjusted earnings per share at $6.91. And now this is what the market looks at for their analyst estimates. They're looking at the adjusted number. So what does that adjusted number include? The first thing is this big $7 billion loss. This is the loss on that Brazil subsidiary sale. Essentially, we're adjusting for that because it's a one-time event. It's not going to happen on an ongoing basis. It's not a part of operations. And like I said earlier, it might realistically add value to UnitedHealth because they're getting rid of a loss-making division. The other part of the $6.91 adjusted earnings per share is cost related to the cyber attack. We'll break those down in a second. Coming over to the cash flow statement, however, it's not as pretty. They generated $1.1 billion in cash from operations with $743 million in capital expenditures. That leaves us with only $401 million in free cash flow for the quarter. That's a pretty massive drop from the over $15.5 billion last year. However, we can see the primary reason for that drop is the change in working capital. Like I pointed out earlier in the summary of the earnings release, they had that $6 billion in funding they had to pay out. And we can see the result of that in this number here. So that was yet another reason I was a little perplexed at the jump in the market today. To me, it seems like a very mixed earnings. The free cash flow is down. Earnings per share took a large hit, but they also had growth in enrollments. Medical cost ratio was down though. Very mixed bag. See, the other reason I think the market actually climbed a bit today was their forward guidance. You can see here it's at $27.50 to $28 for their adjusted earnings per share. Now that guidance remains unchanged. However, analysts had revised downward a little bit after some of the news that came out earlier this quarter. But UnitedHealth essentially reiterated their initial guidance for 2024, and I think that calmed the markets down a little bit. Thus, we're now going to see that correction upwards in UnitedHealth's share price. So what does this impact on their valuation? After that jump in the market today, is it still worth buying UnitedHealth? So after updating with Q1 numbers, they have a trailing 12 of $379.5 billion in revenue. This $400.5 billion in revenue, this is how much my new projected revenue is for year one. It is about 0.25% higher than my original projection. So what this entire year one beat miss column is telling me is how much ahead or behind am I from my original projection for year one. You can see on the other numbers here, we're slightly ahead for the operating profit and income. However, we're slightly behind on diluted earnings per share and very far behind on free cash flow. And on that free cash flow, we can see here that if they perform the way they did the last 3 quarters of last year, they're going to get back to a free cash flow number of around $18 billion. Still way under than what they did in 2023 at $25.6 billion. But what I'm speculating here is normally what they do in Q4 is they fund a lot of their working capital, which would lower your free cash flow. Now I'm speculating they did that again in Q1 this year. So we should see a much more normalized, maybe even higher next 3 quarters. That said, I did adjust free cash flow in my assumptions in order to account for the large drop that we saw in Q1. My year one assumptions now, I did change them a little bit to come more in line with the results that we saw. I increased the operating percent for this year to 8.35%, up from 8%. Slightly decreased interest expense margin from 11% down to 10.75%. And decreased the income tax from about 21% to 19%, but I really lowered the free cash flow conversion. I had it at $1 for my year one estimate previously. Now it's at 80 cents. And here's where you can really see the effect of all that. My free cash flow now is at about $19.3 billion, a 24% decrease year over year. The rest of the numbers are very, very similar, slightly changed, but not much. So how much is this downward revision in free cash flow really going to affect our valuation? All right, so the market closed today at $468.89. And using our base case here, you can see I have a discounted cash flow of $654.84 and a dividend discount of $640.44. The exit multiple is at $416, and that's due to the much lower PEs for their peers. Averaging all that together, we still have an upside of about 26% for UnitedHealth. And at a 10% margin of safety, that's an acceptable buy price of up to $532.38. That would be a forward PE of about 20.2. At a 20% margin of safety, we're looking at an acceptable buy price of $473.22, which gives us a forward PE of 18. Coming over to my investment summary page here, we can see those forward PE ratios. They're right in line, actually, with their 5 and 10-year averages. So in my opinion, there's still quite a bit of value left on the table for UnitedHealth. Coming over here, we can see I'm using a 15% margin of safety, just cutting in half that 10 and 20. That gives us an acceptable buy price of $502.80. I still believe that UnitedHealth is quite undervalued and that there's still room to grow for this stock. The earnings release today really calmed the market, in my opinion. They didn't alter their guidance that much, and they showed that they're still really doing a great job of growing both of their businesses, the health insurance and the health providers. It's too early to tell what's going to happen with UnitedHealth for the next few weeks and months. Humana's earnings are also right around the corner, but I think so long as they're still under about $500, it's a very good value. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.